I want to get your perspective on something. So we have oftentimes come across folks that have a liquidation event where, Jack and I are working on helping them exit the business. Then they exit, and all of a sudden there's this windfall. And the first time they hear about estate planning is at that time, or the first time that they care at least to talk about estate planning is at that time. But they've got significant assets here. Yeah. And so they might have children. Maybe some are married, some are not married. They want to make sure that they're protected as well. And so a lot of times they'll call us and they'll say, hey, what do you think about FLPs or this or some other technique? Tell me from your perspective, when you get a call from a business owner who's just had a liquidation event and they're like, all right, I got this money, help me protect it.
Yeah.
What happens there?
Yeah, I think the family partnership that you mentioned is a really good option to consider, because not only does it maybe provide some of the asset protection pieces that you're talking about, but it can also lend itself to estate planning down the road. And maybe it's not something that they need to do today, right this moment, but in the future, if it's already in place, it's one less step for them to have to take when maybe doing some wealth planning down the road. And so that's probably step one. Is if I get that question, would be to bring up, all right, well, let's talk about maybe a limited partnership type of an entity, because it probably checks the box, or at least somewhat checks the box on your asset protection questions, but also maybe future estate planning needs that you're not thinking about at the moment. We can talk about that as well, and talk about all of the benefits that the partnership might provide, from the estate planning and wealth transfer, family succession side of things as well.
Yeah, let's define asset protection, because I hear it thrown around a lot. But what is asset protection and what is it not? So
what it's not is I get questions all the time about, well, I need to form a trust for asset protection. I was like, well, let's talk about, I don't think you're thinking exactly it's going to do what you think it's going to do. And so I get a ton of questions about, well, can I just create a trust for myself, put my stuff in it, and now my assets are protected? And no, not really. That's not how that works, because you can't create a trust for yourself to be the beneficiary of that trust and get the asset protection. There's some crazy state statutes elsewhere that we don't need to get into, Alaska and South Dakota and things of that nature, that I'm not even qualified to talk about. But in most instances, no, you're not creating a trust for yourself. You can't do that and still get the asset protection that I think that you're trying to get, right? So that conversation usually goes away pretty quickly and then leads to something like a partnership or an LLC. And so, what the asset protection piece of it is, I suppose, is, a client moving their assets into some type of an entity. More often than not, I'd say probably it's a limited partnership. It can be a corporation, it can be a LLC. It just, I guess, depends on the circumstances. But then that entity, as long as the formalities are followed and there's other things at play that you have to pay attention to. But if you're trying to protect your personal assets by having them in an entity, then ideally the stuff that you do elsewhere that could lead to some sort of liability doesn't necessarily attach itself to those assets that are in the entity. There's, something called a charging order that, a creditor, if they have that and you're not, you've got some liability that hasn't been paid, they can get what's called a charging order. But the charging order doesn't, what it does is it said the creditor gets to basically step in line in front of you if a distribution comes out of that partnership entity or LLC entity, right? But it doesn't give them the ability to force a distribution. And so what you end up with is it's not, foolproof asset protection, because you've still got the charging order possibility, but the charging order doesn't give the creditor any sort of rights to break into the partnership and say, well, I distribute these assets out to me to pay this debt so I can be made whole. It's just, if you ever distribute them out and I can't force you to do that, then I get it instead of you until I'm paid off. But obviously doesn't take a genius to figure out that you're probably never going to distribute anything out. And so ultimately what that usually leads to is negotiating some sort of a settlement, say, okay, how much is it going to take for you to just go away and let's put this to bed? And so it's a negotiating tactic of sorts to say, you don't want to just sit here with this charging order and never get anything, more than likely. And I don't want to have you hanging over my head for the rest of my life. So let's work out a deal to get you to go away.
So it's more of a deterrent rather than, because there's no such thing as full blown asset protection, right?
Yeah.
It's just it just doesn't exist.
Yeah.
Okay.
Yeah. I mean, something that people need to keep in mind, and I always remind them, is that, you're always responsible for your own negligence.
Right.
So, driving a car and hurting another person is a very common way that we risk ourselves and getting sued for negligence. Having maybe a workman or some type of slip and fall event at your home. These different areas where we have exposure. A lot of times, laws are in place, or there's certain mechanisms about owning a home or driving a car where we already have some sort of insurance. And for the vast majority of people in this country, the asset protection they have is their homeowner's insurance and their auto insurance. Right. But for certain people, then it makes sense to get a general liability policy. And then on top of, once you get to a point where you have enough assets that you've accumulated over your lifetime, or because you've been successful in business, it starts to make sense to look at other ways to protect your assets that isn't just, okay, I have an insurance policy protecting me from certain events.
Yeah. So we're talking about FLPs here, and the F stands for family,
right?
Which means that there's other members of the family coming into play. So what's the significance of that? Who are these people that are involved, and why the family limited partnership? What does that look like? How does it work?
Yeah. So the family, I mean, and I guess the typical lawyer answer for every question that's ever asked is, well, it depends. But I think, the majority of the time it's oftentimes going to be used in succession planning, whether it's you've got a closely held business and, maybe mom and dad ran the business for decades and they're getting ready to retire. Maybe it's the liquidity event that you mentioned earlier, or, whatever it is. But some portion, I say mom and dad, it can be whomever, but typically it's sort of a senior member of the family, whether it's grandparent, parent, something like that. They'll contribute some portion of their assets into the limited partnership. And then the kids can either also make some contribution to the partnership and have a pro rata ownership interest. A lot of times in the estate planning context, then, the parents will contribute all of the assets into the partnership. They'll initially own 100% of the partnership. Now, 1% or maybe 0.1% of that would be a general partner, right? Because every limited partnership has to have at least one general partner. Typically, the general partner is going to be a type of an entity like a LLC because of the unlimited liability that a general partner has for the actions of the partnership. But so let's say mom and dad have the 99% of the limited partnership interest, then they can use, their lifetime estate and gift tax exemptions to make gifts to their kids. And that's the way to get the kids involved that way as well as part owners. And so, the kids could buy it from mom and dad. I mean, there's any number of ways to get them involved. It just, again, kind of depends on the circumstances.
Yeah. And with the kids, a lot of times we have the senior generation, let's call them the senior generation. Right. They're worried about their kids being, taking all this money and spending it after they're gone. They're worried about the 4 horsemen of the apocalypse coming into their lives. And they're worried about, the future in-laws and the creditors and the predators and such. And so how does that play in when you're doing planning using an FLP, where senior generation says, you know what, I want to make sure I protect my kids against themselves? What are some of those benefits of an FLP, and how does it work?
Yeah, so the going back to, I mentioned the general partner, right? So mom and dad can retain ownership, or the senior generation will say can retain ownership of the general partner that has maybe a 1% interest overall. The general partner is going to control everything that the limited partnership does. And so it's a way for the senior generation of folks to transfer, whether it's by gift or sale or whatever, to the kids. But the limited, and that would be of limited partner interest, right? The limited partner interests don't really carry any control of the partnership itself. And so while the kids may be getting something of value, they're not really getting any control over the partnership entity. And so they can't take that limited partnership interest and take it to the Ferrari dealership. The Ferrari dealership's going to say, that's just a piece of paper. It means nothing. They can't go back to the partnership and say, well, this is worth whatever, $10 million. Give me $10 million, because then the general partner can say, yeah, I'm not going to do that. And there's not really anything that they can do to get the distribution made. Outside of the general partner being, breaching some sort of fiduciary duties or committing fraud or something, the limited partners have very little control ability over how the assets get invested, when they're distributed, if they're distributed, things of that nature. And then you can add another layer of protection against themselves, the kids, for the kids against themselves, by instead of just gifting, selling, whatever, transferring the limited partner interest to the kids directly, giving it to a trust for their benefit. Whether, if you had 3 kids, you could do 3 separate trusts. You could do one group trust with all 3 kids, but, put it in the trust, have a third party trustee that controls then what happens to the trust asset. So the trust asset is limited partner, percentage ownership. The general partner controls the limited partnership. Let's say that they do decide to make a distribution someday. Well, then that distribution goes into the trust. Now the trustee, who's not the kid or kids, decides, okay, well, now they've got control of, let's say it's $100,000 distributed out of the partnership. That goes into a trust account that now the trustee manages that. And the trustee can decide when, depending on how the trust is set up. But you probably would have, if you're trying to protect the kids against themselves, you'd probably have some sort of health, education, maintenance, support standard for the trustee and not mandatory distributions from the trust. That would kind of defeat the purpose. So,
yeah. So sounds like it's a great way to have the kids avoid having that prenuptial discussion.
Well, right. Yeah,
Right.
exactly.
Yeah, that's a great point. Yeah.
Right. And so, and forces the kids to get along.
Right.
Right. So gives the senior generation some control there. So you also mentioned gifting. So let's talk about that a little bit, because we have the sunset provisions of the Tax Cuts and Jobs Act coming up.
Right.
So it's been, 6 years now, 7 years? I can't keep up. But it's going to sunset here in 2025.
Right.
And so we have a window of opportunity for people who are thinking about making transfers. That exemption is going to go back to where it was. Right? Automatically at sunset. Right. And so, and the IRS came out a few years ago and they said it's use it or lose it.
Right.
And now we have a situation where we have, especially for folks that have commercial real estate holdings, where we have asset prices are suppressed. We still have valuation discounts that we could still use. And we have the sunset provisions coming up. Isn't this one of the greatest times ever for wealth transfer, or am I missing something?
No, I think it is a very good time for wealth transfer for all of those reasons that you stated, right? There are, not only is it real estate that may be a little bit depressed, but, as oil and gas fluctuates all the time. And, in Houston, I've got tons of clients that are either whether it's I own Exxon stock or it's I work for an oil and gas company and I have a ownership, in the company that's worth, today it's worth 30 million and last week it was worth 2 million. It's always up and down. And so when you can time it right to make gifts when oil kind of is on a downswing, knowing that it's almost certainly going to at some point come back up, it's a great time to utilize, FLPs and gifting and whatnot. And again, because like you mentioned a second ago, that the lifetime exemption is so high and it's going to go away. And so, you're talking about, a married couple can, sort of combine their exemptions together and you're almost at 13 million per person. So you're looking at a married couple can basically transfer 26 million of assets without having any sort of estate gift tax consequences to it.
Yeah.
That's going to at best be cut in half. And so you're going to, you're losing 13 million of ability to get those assets out of your estate. And, if you're younger people and you've got a large estate, that's years of appreciation that could be happening outside of your estate versus inside your estate.
And that's not including valuation discounts. So
that's not including valuation discounts. Yeah. Exactly.
But time's running out. And it's time to go. You were going to say something?
Well, I was going to ask, because I never remember, what is the tax rate on gifts and
state? 40%.
40%. So 40%. That's pretty substantial.
Yeah.
Yeah. So you're not inheriting $1 million. You're inheriting the $600,000 that's left per $1 million. Yeah.
400,000.
The silent partner. Right.
Right.
Now, you also talked about corporate governance. So I want to go back to something elementary. People that go into business, most people know, hey, don't operate as a sole proprietor. Right. And they'll say, well, I just formed an LLC, or I filed for this entity. So choice of entity formation is one thing, but then following corporate governance is another. So what are some pitfalls that you see people make when, they'll start a business or they'll acquire a property and they'll say, oh, it's in an LLC, but then, there's zero corporate governance. There's no meeting minutes, corporate meetings, nothing. What are some of those pitfalls that you see?
Yeah, I think that one of the biggest ones is I formed an LLC and it's in an LLC, but yet it's really not in the LLC, right? I mean, forming it, that's step one, but other things have to happen too, like opening a bank account. And, if you've got equipment or real estate that's involved, that you use in the business, actually transferring that stuff into, you got to retitle that stuff into the LLC, have bills of sale for equipment and things of that nature. File deeds if you've got a building or real estate or something that you're using. And I mean, it seems pretty simple, but I think you'd be surprised about the people that don't get around to doing it, or don't take the time to do it, or think that they've done it correctly, but they really haven't. Keeping your personal assets and the business assets separate is another one that you would think is kind of, oh yeah, that makes sense, but a lot of people don't do it. And the biggest one is the, commingling funds, where they have a personal expense that they spend out of the business account, or a customer, oh, here's a check for whatever services you provided, and they deposit it into their personal account and whatever. It gets all mixed and mingled. And then, like you said a second ago, they don't keep minutes. They don't have a, corporate book, or a, company book, or a ownership ledger, or any of those things that, I mean, you can go on the internet and download a template. I mean, that relatively easy to get done, but they just don't take the time to do it. And that,
what I've noticed recently is someone will be like, well, I updated the Secretary of State with the ownership. And I sit there and I go, well, depending on how you form the entity or what you put in your or a certificate of formation, it's like they don't know who owns the entity. The IRS might know because of how you file your taxes. So then it's like, and then it kind of dawns on me that they had no help putting this together.
Yeah.
And they just kind of assumed intuitively that you would tell the state of Texas or a state of Delaware, and they don't care to know. I mean, that's the way they set up that for a reason. So
yeah. So what is the bottom line problem with respect to asset protection that this creates?
I think the bottom line problem is that if you're not keeping your business assets, or the assets that are supposed to be separated in the entity, away from commingling them with all of your personal assets, or treating it, like it's one and the same, is that, I think we've all heard the piercing of the corporate veil. If you got into some sort of a lawsuit or some sort of a dispute, chances are that the corporate or LLC or partnership entity will just be disregarded, and whatever you put into that entity as a means of asset protection, it's not going to get any asset protection, because it'll just be disregarded, like it was never formed in the first place.
Yeah, defeats the whole purpose.
Defeats the whole purpose.
Just because of,
right.
It's amazing to me. People spend all this money setting it up right, only not just so that they don't follow the simple procedures and then they undo everything. So we've been talking about FLPs now as in the realm of asset protection, but that's just one tool, right? It's not the be all end all. There's other tools that people use, and it's kind of like a scale, right? Basic level and moving all the way up. So what are some tools that are used for asset protection, starting from maybe not the person that just had this liquidation event, but your average everyday person? And Jack, you talked about, general insurance as layer one. Yeah. In my world, we use ERISA protection, right? But what are some of the tools that people can use for basic asset protection?
Yeah, I mean, I think looking at, depending on what kind of assets, a good example is I've got numerous clients that invest in real estate and they want to rent it to, whether it's like a Airbnb kind of thing, or they just want to, like a piece of rental real estate, commercial real estate that they rent for office space or whatever, is, having that in like an LLC entity to separate it from the rest of your personal assets, but also your other business assets. I mean, I've got a client with probably 20 rental homes that, we went through and formed a separate LLC for each particular home, and deeded those in there, and they have separate tax ID numbers and they have separate bank accounts, and they're all separately operated. And they don't, I think I wrote him this long letter about do not do these things, and don't, if the house over here needs a new roof, don't just grab it out of this bank account over here and, doing all that sort of stuff. So, I think oftentimes, we'll take the sort of belt and suspenders approach of, you've got the insurance coverage that you've talked about. A lot of clients will have umbrella policies to cover various things, and then, but also having, maybe a separate entity to hold specific assets as another means of protecting either those assets or your other assets that aren't in the LLC.
Yeah. And now, every year the IRS comes out with the list of the dirty dozen, where these are tax schemes, they call it, where they're on the lookout for. They want to audit these. Oftentimes there's these promoters that are selling these, and it gets a lot of people in trouble. And so along this path, these are pitched as asset protection tools. And I just like to understand that, most of the stuff, the basic black letter law, simple things that have stood up in court, a lot of the asset protection needs can be satisfied with that black letter law time tested tools. What do you say to all these different schemes that are out there that are being promoted? It doesn't seem like this is for everyone. I mean, there may be a need for it, right? But it's probably very minute percentage of the population needs this.
Right. Especially with the exemption.
Right. So
right at the moment.
Yeah. So what's your take on this, and what should people look out for as they're being pitched these things? Right. I'll give you an example. This is not asset protection, but something we've talked about before. Do you remember the employment retention credit that came out a few years ago? To this day, I get phone calls saying, "Hey, you might qualify," and I'm like, "We're done." No, but people are making money, so they keep pitching it. So what do you say to people that are getting pitched these asset protection schemes?
Yeah, I think the first thing I would always say is that if somebody is trying to sell you some sort of a plan and that is being done in a hotel ballroom, be immediately wary that maybe they don't have your best interest in mind. But I mean, the every IRS case, every tax case, every revenue ruling, I feel like it's the same language that's always used. It's a facts and circumstances situation. You got to look at more of just, okay, you say it's asset protection, but we got to, you say this, but then we got to look at how it was actually, managed and all of that. And I think that in every IRS case dealing with partnerships or LLCs or whatever, these sort of plans, they always say that if tax avoidance is your primary goal, we're not going to allow it. And so saying it's, somebody says, well, this, you can sell it as asset protection. I think it's another red flag that really it's for this, but you can say it's for that, I'd be very skeptical that it's actually going to work. And so asset protection is a valid business purpose for maybe forming a limited partnership, but then you actually have to show that, yeah, this is why I formed it. Not if you can't show those valid business purposes, then I think the IRS is going to assume that it was tax avoidance. And so if you don't have a legitimate business reason and can't show that, well, look, I've got 22 rental properties and they're all in a college town and I rent to college students that set things on fire, and some of them may drink too much, you can kind of show that I wanted to separate these assets, that sort of thing. But if you just say asset protection and then you don't really do anything that sort of shows that maybe I am actually trying to protect assets. For instance, a lot of the early, maybe not early, but a lot of the FLP cases where the IRS would win, one of the big factors is that, the taxpayer puts all their stuff in it and then just sort of uses it as a piggy bank. Well, that's going to undo your asset protection anyway, because you're commingling and mixing and matching. So clearly asset protection was not that big of a goal or a goal at all. So what was the real motivation behind it? Well, probably the tax avoidance piece of it. And, they disregard the FLP altogether, or the taxpayer loses the case. So,
yeah. I mean, there's not really always going to be a silver bullet, and life circumstances change. But the one thing, I would say is like, who's, with these services that offer, it's like, who's really standing behind this? And do you have confidence that they're going to be around when it's battle tested?
Right.
With our firm that's been around for decades and has all sorts of people to help, litigators, planners. We're around to be around and help you and provide you a surface. And when things go wrong, if they do, hopefully they don't, we'll have people to help you with that. These services, when the IRS sends you a letter or an agent shows up, is this person all of a sudden going to be there to help you out of this mess? Probably not.
Yeah, typically these promoters are not law firms,
right.
Or maybe it is somebody with a JD. Maybe they practice, but their practice is more of selling a service for a fee. And it could get scary. It could get scary because, like you said, they might not be around when the taxpayer gets that letter. And the last thing somebody wants is their name in a case where it's commissioner versus somebody else. And so we talked about, stay away from hotel sales pitches. Okay. But let's assume, the CPA brings this, or their financial advisor brings this to them. And, it's people they trust. How do they go about vetting this? Do they go to counsel, like a tax controversy firm? What's a good outlet that they could go to besides the internet to kind of get an opinion on this? Who do they go to?
I mean, I think going to somebody that does either estate planning as their primary or one of their primary areas of practice, or tax planning. I know lots of people think, well, I can't afford a lawyer. Lawyers are way too expensive. But, most of the time you end up paying more by not talking to a lawyer than you do, than going to him in the first place. So I think, talking to a lawyer that does that type of work, whether it's estate planning, tax planning, things of that nature, because they will have, they should know, what would be a valid sort of structure to set up and what may not work or what definitely won't work. Yeah.
No, there's definitely value in paying a lawyer, and let that be the cost. And I'm going to share a story with you guys. So back in 2008, my wife and I went to buy a condo. Well, in 2008, that was 2008 in Chicago. And in Chicago, they don't use escrow. They use lawyers for closing. And so our attorney looked at the condo association meeting minutes, and he said, I advise you not to buy this. But of course, we're young and we're like, no, we want this. So I brought out an inspector, and he said, everything's fine. So afterwards is when the attorney read these documents, and he said, I advise you not to do it. But because I had my heart set on buying this place, I brought the guy back out a second time, paid him money, and he took out this moisture meter. He said, look, see, there's no moisture here. Lo and behold, 2 weeks later, we get, after we close, 2 weeks after that, we get a letter saying special assessment's $30,000 because all the trusses need to be replaced. There's moisture everywhere. And I paid this guy, and he said, look, my moisture meter says there's no moisture here. Had I only listened to the attorney, it would have cost me maybe $500 and I would have avoided the $30,000. So take that as a lesson. It's cheaper to pay an attorney and have him tell you what not to do than be stuck with something terrible. So we're talking about planning here, but obviously I'd be remiss if I didn't talk about tax controversy, because recently, and I forgot which bill it was, I should know this, but the hiring of 80,000 new IRS personnel, not necessarily agents, but we know, and it's been signaled, the IRS has actually said so, they're going to increase audits. It's going to happen.
Right.
And in fact, I read somewhere yesterday saying because during COVID, they suppressed a lot of the audits, there's an estimated 6 to 8 million CP14 letters coming out. These are the computer generated letters that says, you owe us this much money plus interest, pay up. So people are going to be shocked to get that. But more so with the increase in the number of IRS agents and the examinations, and at least they've signaled that they're going to go after wealthy folks. And obviously, wealthy folks are the ones that have these asset protection plans in place. So obviously, it makes a lot of sense to make sure you do it right. But from a tax controversy perspective, what are some things that we could anticipate moving forward? What are the examinations that the IRS is going to do? Are they going to go after the, just the basic black letter law things just to make sure it's being done right? Or are they targeting these tax schemes that are somewhat, gray area?
I think on the tax scheme, that I would suspect that at least some portion of the new 80,000 employees are going to be focusing on those types of tax schemes because, oftentimes the practitioners, the planners try to stay one step ahead, and then they get caught or they get shut down, or there's finally a tax court case that says, okay, well, this scheme is not, this doesn't work, and so they move to the next one. And so, given that they maybe have been understaffed, or with the COVID and all of that maybe trying to do a little catch up on things that might be getting sold in the hotel ballrooms that they haven't quite gotten to yet, I would suspect that would be some part of the responsibilities of the new agents coming in. Yeah.
What's your take on getting a private letter ruling if somebody has doubts? Maybe they're bought into something and they like the people that are talking to them about it. Maybe they didn't meet somebody at the hotel lobby or the ballroom, but they still have some questions. What's your take on getting the private letter ruling?
Most clients that gets brought up to, they don't want to pay the cost of it because it's pretty expensive, not just paying the attorneys to prepare it and file it and deal with the IRS, but the I can't remember what even is to file with the IRS, but it's
close to 20,000.
Like 20, I was going to say it's around 20,000. It's pretty hefty. I mean, obviously, if you get it, and I mean, it helps, right? It can only help, but it's at what cost? I guess does it make sense? It just depends on the circumstance. I guess I don't know that I have a hard and fast. It's great, you should always do it, or it's a waste of money, you should never do it. It's kind of depends on the circumstance.
Yeah, I think that's right. I mean, if like the planners that we work with, like the strategies implement, usually they're kind of tried and true methods. So if you're coming to us early and we're helping you work through something kind of at an early stage, we there's a level of confidence that, if it's tested, like we can get through this just by explaining to an auditor or whatever. But if you're have some plan in place that they'll come to us and be like, what's going to happen? And we'll be like, like, I don't know. All of a sudden, if this peace of mind, the private letter ruling might give a blessing to something that we have no idea about. Or it's going to give you a sense, okay, this is how we need to mitigate any problems.
Yeah. So let's talk about that, because we've been talking about FLPs and asset protection on its own. But you mentioned early on how it could be foundation for estate planning. How does it all work together? At what, which comes first, the FLP or the estate planning, right? How does it work? What's the ideal way, I suppose, somebody does this?
Yeah, I mean, the ideal way, well, I guess to the first question, what comes first? The FLP and the estate planning don't necessarily have to be done jointly. And by estate planning, if you're just talking about, I need to set up a will and, that sort of thing, that can be done on its sort of own separate basis. A lot of times it might be done together if a client comes in that has nothing done and says, okay, well, I probably ought to get a will. And, oh, by the way, I have a net worth of $70 million. And it's like, well, we need to talk about more than maybe just a will because you got a lot of things going on. Ideally though, the setting up of the FLP will be done, maybe as far in advance as you can do it, ahead of your liquidity event or whatever it is. That's doing it earlier rather than later is better.
Okay. What's the profile of somebody that could benefit from an FLP?
From an estate planning side, we talked about the asset protection stuff. Obviously, that has its own merits, but I'd say somebody that is, again, it's different for everybody.
Sure.
But somebody that's approaching the exemption level or definitely over the exemption level. Because you mentioned a little while ago, FLP can potentially bring some valuation discounts. And so, if you're going to gift limited partner interest to, let's say, trust for your children, those limited partner interests could potentially be discounted somewhat for various things like a lack of marketability. They're limited partnership interests that don't have any, voting rights or control over the assets in the FLP. So a potential lack of control discount. And so, if you were to just give the assets outright, maybe it's $10 million worth of assets, but if you put those assets in the FLP and then gift partnership interest, you could perhaps get some discount. How big, again, depends on the circumstances, but if it's 25% or 30%, that's a pretty big discount,
right,
on $10 million worth of assets if they were just out of the partnership. And so you're potentially moving more value out of your estate, using less of your exemption to do so, in order to, transfer those assets to kids, trust for kids, whatever it is.
Yeah. Here's a question I get a lot when I suggest to a client that, hey, we should probably go talk to an attorney about setting up an FLP is, what about the maintenance? What does that look like? Okay, so we've set this up. What are my responsibilities every year, and what is it going to cost?
Right. That's a consideration because it's going to have to file a partnership tax return every year. Partnership tax returns are typically a little more complex than, your average TurboTax user person. So you're probably going to have to hire a CPA firm to do it.
If they want you as a client these days.
Sure. Right. Right. So yeah, there is an ongoing maintenance to it. There's the annual filings with the, assuming we're talking about a Texas limited partnership, right? You've got to file annual, either no tax due franchise tax returns, or you've got to, keep an eye on, do I owe franchise tax, depending on what your partnership is doing and all that kind of stuff. So there is a maintenance to it. There is an annual cost to it. You've got to, I guess, look at, is that worth having that annual sort of administrative cost and administrative burden to keep up with some of these filings on an annual basis? Is that worth what I'm saving, potentially saving by setting this whole thing up, or what my goals are in setting it up, right? So if you aren't going to have any tax savings because you're not anywhere near the exemption limit, so if you were to die, you're not going to pay state tax anyway. Well, maybe it doesn't make sense to do it if that was the only reason you were trying to do it, set it up in the first place, right? It maybe doesn't make any sense to do that. Or you're worried about asset protection, but you're retired and you don't really do anything but go fishing and play golf. And, the chances are that you're going to be in some sort of a situation where you need a asset protection, maybe that doesn't really, maybe it only exists in your head and not really in reality, right? It's, things like that. Maybe it doesn't make sense to do it.
So besides the tax filing, paying a CPA to do that,
right?
Are there any other things that
you need to do? Yeah, it needs its own tax ID number and bank accounts, right? And all of the sort of corporate formalities that we talked about earlier. You still need to do those things, not commingle the partnership assets with your personal assets. That's if the IRS comes auditing, that's a surefire way for them to say, yeah, this is not a valid entity.
I've seen like people put their, ranch that they live on, or they live half the year on, or their vacation home that they, spend the whole summer at, into their FLPs. And it's like, well, that's not separating it from your estate.
Right. Yeah. You're running a business. It's a business. So you got that administrative burden of doing that. And so, when we look at going back to the first question that we asked today was, got a client that's got a liquidation event and they've heard about all these things. So, and I'm always wary of talking to clients about specific tools because they fall in love with that idea when it's
the sexy idea.
Yeah, no, that's not necessarily right for you. So what's the process that you would advise somebody who says, you know what? All right, I got to look into this. I've been thinking about doing planning for a while. What's the starting point?
I think the starting point is, what kind of planning are you talking about? Is it, I want to do the asset protection piece of it? Is it, I want to do some gifting to maybe try to lower my estate down under the taxable level, figure out what the goal is, and then kind of figure out, okay, well, what assets do you need to live on, right? There's that question that I think oftentimes sort of gets skipped over because, I can just put all my assets over here and then they'll be protected or they'll be out of my estate. It's like, well, you still got to live on something. You can't, another surefire way to have your FLP sort of disregarded is to put 99% of your assets into it and then live out of it like it's your, piggy bank. So we still, what are you going to need? If your liquidity event is when you're 30 and you've got a long life ahead of you, you can't just park everything in an entity, right? Do you have kids? Do you want to set up trusts for them and maybe gift some of the FLP ownership or some of the assets into trust for them? So just figuring out the family dynamic and the overall goal of setting it up in the first place. What are you trying to do? That's
I would say also for that initial meeting, what's helpful is, come in with your personal balance sheet, pretty organized.
Right.
What do you own? What are your liabilities? All your real estate that you own, the different, stock that you own, and from that balance sheet, someone like Ryan could sit there and kind of get pretty organized about, okay, this is what makes sense to move and not move. And you're already like one step ahead, because I'm sure the initial conversation is just talking, but it's like, then it goes into, okay, what do you own? If you come in with already having an organized presentation of what you own, we're already getting to the second meeting and the first meeting.
Yeah. Final question. I've seen this where people have set up an FLP maybe 20 years ago, and good for them. They started early, right? Versus the nightmare scenario of grandma's on her deathbed and she's making decisions, and that's not going to hold up. But folks that have set this up some 20 years ago, and obviously in the tax world, legislation changes all the time. But if they haven't looked at this in 20 years, how often should they be looking at their FLP structure and updating it or modifying it, or assuming no major life events, right? Their kids are a little older now, but nothing's really changed. How often should these things be looked at?
I would look at it. If it were me, I'd probably look at it annually. You want to keep on top of it. I think ideally, if you can get a client to look at it every 2 or 3 years to make sure the structure still works, that would be great. Most clients probably don't do that. But the hope is that if they're keeping it in good standing by filing all the stuff with the Secretary of State and filing their tax returns on time, that a CPA or their attorney or somebody is at least looking at on an annual basis, okay, I've got to file the tax return, so I need some information about what I'm filing. And so if the client themselves aren't keeping an eye on it, hopefully somebody that has fairly regular involvement is keeping an eye on it. It can say, all right, I know that you just got divorced or you just got married or whatever. Maybe we need to talk about that, or, whatever the case might be.
Yeah. And so in reality, the FLP is just an asset. The estate planning part, as far as what to gift, sell, all that, that's a completely separate issue. And so they probably should be looking at it in conjunction with their overall estate planning.
Right.
Would that be fair?
Yeah. In the gifting context, I think you have to look at it in conjunction with your overall estate plan, because if you look at it in separate boxes, and it doesn't fit, it could have, bad repercussions.
Yeah. And I've noticed that some CPAs are really sophisticated in this, and they're coming to us already pretty much with the plan, and we're there to just help look at it and go execute it. But some of it, the CPAs aren't so sophisticated, and we're coming in with the plan and the execution. And so depending on how sophisticated your CPA and specializing in this, I'm not saying someone has to run out and all of a sudden change CPAs, but it's part of being a team. And we've talked about this before. Right. You have different members of your team, and some are stronger in different things than others. Yeah. And so depending on how strong your CPA is, who's filing returns and all that stuff, might make sense for your lawyer and planner to look at it more versus if not.
I know I said last question, but he brought up a good point, so I want to follow up on that. What's your take on when people like me come to you with a client and where we've kind of said, hey, this is what we want? Do you get annoyed with us?
No, not really. Unless you're completely closed-minded and like, no, we got to do this. I'm not, I'll get all the time. I'm not an attorney, so I can't actually do it, but this is the plan. This is what you should do. And obviously, if you take on the client, you've got an obligation to do what's in their best interest. And so if the plan is not maybe in their best interest, you've definitely got to tell them, yeah, if you do it this way, these are some of the issues that might happen. But I always try to do it in a way that doesn't offend the CPA or the financial advisor, whoever it is that brought them in the first place. I try to say, well, ideally, I'm meeting with the client without that person there. And so maybe the conversation is a little bit easier to have. But, I very respectfully say, well, this might be a good plan, but in your case, it might not work because, or just in general, well, one issue that we've seen before is maybe this will happen, again, depending on what the plan might be. So, I definitely don't get annoyed, but sometimes you have to say, well, as good of a plan as it maybe seems at first, it really isn't that good of a plan for whatever the reasons might be.
Information contained in this podcast and accompanying video have been derived from sources believed to be reliable. This content is not guaranteed as to its accuracy and does not purport to be a complete analysis of the topics discussed. Analysis is based on assumptions that may not come to pass. None of the content should be construed as legal or investment advice. You should consult with a qualified professional before implementing any strategies discussed. All expressions of opinion reflect the judgment of the speakers on the date the video was recorded and are subject to change.